Why is Microsoft up 5% while Alphabet is down 6% despite both companies reporting strong earnings? Let's dive into the details and understand the key highlights of their recent financial performance. Microsoft versus Alphabet, a snapshot of valuation metrics. Before we delve into the earnings reports, let's take a moment to look at the current valuation metrics for Microsoft and Alphabet compared to their 5-year means. Traditionally speaking, Microsoft appears more expensive, with a higher price-to-earnings (PE) ratio and other valuation metrics like EV to EBITDA, price-to-sales, and price-to-free cash flow all pointing towards an overvalued status. On the other hand, Alphabet seems undervalued in most metrics, except for price-to-sales. But don't let these numbers deter you from considering these tech giants as investments. Both Microsoft and Alphabet are exceptional businesses with tremendous growth potential. Microsoft is on the cusp of significant growth in areas like AI, cloud computing, and gaming. Their presence in the cloud industry, alongside AWS and Google Cloud, indicates substantial room for expansion. Moreover, they're now a major player in the gaming industry, thanks to the acquisition of Activision. Alphabet, too, is on a remarkable journey. While the stock might appear undervalued according to some metrics, its progress in AI, search, YouTube, and cloud services cannot be understated. Additionally, it's essential to remember that both companies operate in industries with vast growth potential. So, while traditional valuation metrics might suggest high prices, the future looks promising for both Microsoft and Alphabet. What are your thoughts on the valuation metrics? Leave a comment below to share your insights. Alphabet, the comeback kid. Let's begin with Alphabet, the parent company of Google, which has experienced a noteworthy comeback in recent times. Earlier in the year, the stock faced challenges due to various factors, including concerns about artificial intelligence. However, they seem to have turned the tide. In their latest earnings report, the CEO and CFO expressed their satisfaction with the company's financial results and product momentum. AI-driven innovations have played a significant role in their success, spanning across search, YouTube, cloud services, Pixel devices, and more. The future of AI looks bright, with exciting progress yet to come. Notably, their revenue for the quarter reached $76.69 billion, marking an 11% year-over-year increase. Operating income stood at $21.34 billion, with an operating margin of 28%, showing improvement year-over-year. Net income also witnessed a substantial boost compared to the same quarter last year. Google advertising and YouTube ads continue to grow year-over-year. These positive results are not just good news for Google but also for other players in the advertising industry. In a surprising turn of events, Snap Incorporated reported an astounding 133% increase in its stock price, while Alphabet saw a 6% decline. However, the cloud segment seems to be the primary reason for Alphabet's stock decline. Although all other segments beat expectations, Google Cloud fell short. With a year-over-year increase from $6.86 billion to $8.41 billion, it did not meet the market's anticipated growth rate. As for stock buybacks, Alphabet remained consistent with its previous repurchases, amounting to $15.78 billion. The company reported free cash flow of $22.6 billion, with net cash provided by operating activities totaling $30.65 billion. Considering these results, Alphabet is navigating through a challenging period. The stock has dipped, but the company remains a promising player in the tech industry. As the cloud business continues to evolve and expand, it's crucial to keep an eye on how Alphabet adapts to this changing landscape. Do you believe Alphabet's stock dip is a buying opportunity, or do you have concerns about their cloud business? Share your thoughts in the comments below. Microsoft, impressive growth. Now, let's shift our focus to Microsoft, which also reported robust earnings. Microsoft's revenue reached $56.5 billion, marking a 13% year-over-year increase. Operating income saw a substantial jump, increasing by 25% to $26.9 billion. The net income amounted to $22.3 billion, reflecting a remarkable 27% increase. Diluted earnings per share also rose by 27%, reaching $2.99. Microsoft CEO, Satya Nadella, emphasized the role of AI in their growth, particularly with AI-driven innovations like Copilot. Their commitment to infusing AI across various tech layers and processes is driving productivity improvements for customers. Microsoft's cloud revenue of $31.8 billion, up 24% year-over-year, sets a high bar in the industry. Breaking down their performance by segment. Productivity and business processes. Office 365 commercial revenue grew by 18%, while consumer products and cloud services increased by 3%. Microsoft 365 consumer subscribers reached 76.7 million. LinkedIn revenue increased by 8%, and Dynamics product and cloud services revenue grew by 28%. Intelligent Cloud, server products and cloud services revenue rose by 21%, primarily driven by Azure and other cloud services, which saw a remarkable growth of 29%. More personal computing, Windows revenue increased by 5%, with Windows OEM revenue growing by 4%. Windows commercial products and cloud services revenue surged by 8%. Xbox content and services revenue increased by 13%, and search and usage advertising revenue, excluding traffic acquisition cost, grew by 10%. In the first quarter of fiscal year 2024, Microsoft returned $9.1 billion to shareholders through share repurchases and dividends. Their outstanding performance indicates a company in good health and with a bright future. As for their stock, Microsoft reached all-time highs in after-hours trading, hovering around the $240 range. This price level has seen resistance in the past, but Microsoft's impressive earnings might be the catalyst to break through and establish new records. Now, the question is, will Microsoft's earnings call further boost the stock, or could it introduce factors that influence it negatively? Share your opinions on Microsoft's growth and the tech industry in the comments below. In conclusion, both Microsoft and Alphabet have presented strong earnings, but market reactions can be influenced by various factors, including individual segment performance. While Alphabet faces some challenges in its cloud business, it's essential to recognize its overall potential. On the other hand, Microsoft's impressive growth in various segments indicates its strength in the tech industry. Remember that stock prices can be influenced by short-term market sentiment, but the long-term prospects for these tech giants are promising. As investors, it's crucial to assess the broader picture and consider how these companies are positioning themselves for future growth. Disclaimer: this information is for educational purposes and should not be considered as financial advice. Always conduct your research and consult with financial experts before making investment decisions.
Before you go, help us by smashing that YouTube like button. And subscribe to this channel, so you won't miss any of our videos. This shows YouTube algorithm that you value our information. And it helps us spread the message. Sharing is caring.